If you're over 35, you've probably seen your fair share of markets ups and downs. Maybe you've even lost some sleep over them. Today, we're diving into what's the difference between a crash and a correction. Plus, I'll unpack those sneaky bull market traps you need to watch out for and how things like the VIX and Trump's tariff talks are shaking things up. Stick around because understanding this could save you a lot of stress and maybe even some money. Let's start with the basics. What is a stock market crash versus a correction? If you're over 35, you might remember the 2008 financial crisis or even the dot-com bust. Those were crashes, big dramatic drops. A crash is when the market plummets 20% or more, often in just a day or a few days. It's like the floor falls out from under you. Think panic selling headlines and your 401k looking like it took a vacation without you. On the other hand, a correction is much milder, usually a drop of 10% to maybe even as much as 20 from a recent high, and it happens over weeks or months. It's the market's way of catching its breath, coming back to reality after getting a little too excited. Right now, as of April 2025, the S&P 500's been flirting with correction territory, down over 10% from its February peak, thanks to all this tariff talk. Here's the key. Corrections are normal, even healthy. They happen about once a year on average. Crashes, those are rare. Game-changing events. Knowing the difference helps you stay calm when your portfolio takes a hit. A correction might mean hold tight, while a crash could signal bigger trouble, like a recession, which brings us to our next point. Let's talk about bull market traps, something every investor over 35 should have on their radar. A bull market is when stocks are roaring upward, and it feels like everyone's making money. But here's the trap. Sometimes that optimism tricks you into thinking the good times will last forever. You might jump in late, buying at the peak, only to see the market turn south. Think about it. How many of us got excited after Trump's election win in November? The S&P 500 jumped 2.5% the next day. But fast forward to now, and we're down over 12% since then. That's a classic bull market trap. A quick surge lures you in. Then reality like tariffs or geopolitical drama kicks in. For us over 35, with retirement creeping closer, chasing those highs can sting. The trick, don't get greedy. Stick to your plan, and don't assume every rally is a green light to pile in. So why does the market feel like a roller coaster lately? Let's enter the VIX, Wall Street's fear gauge. It measures how much investors expect the market to swing based on options trading. When the VIX is low, like under 20, things are calm. When it spikes, like it has to over 40 this month, people are nervous. And boy, are they nervous now. Back in March, the VIX hit 27 as tariff talks heated up. Today, it's at historic highs, topping 50 at times. Why? Uncertainty. This matters because volatility can tank your nest egg if you're not prepared. A high VIX doesn't mean a crash is coming, but it's a warning sign. Think of it like storm clouds on the horizon. The higher it goes, the bumpier the ride. Let's talk about what's driving this storm. Trump's tariff talks. Since February, the Trump administration's been rolling out sweeping tariffs, 10% on all imports, 25% on cars, even threats of 50% or higher on China. It's rattled markets big time. Why? Tariffs mean higher costs for companies, which can slow growth and spark trade wars. Geopolitical tension is the fuel here. China's hitting back with 34% tariffs on U.S. goods. Canada and Mexico are retaliating, and Europe's talking countermeasures. For us over 35, this isn't just news, it's personal. Higher prices could hit your budget, and a prolonged trade war might tip us into a recession. Goldman Sachs just tipped its recession odds to 45%. That's why the VIX is screaming. Markets hate uncertainty, and right now, it's anyone's guess how this plays out. What's the takeaway? First, don't panic. Corrections happen. Crashes are rare. Second, watch out for bull market traps. Don't chase the hype. Third, keep an eye on the VIX and big geopolitical moves like tariffs. They're driving this volatility, and it's not going away anytime soon. So here's my advice. Diversify your portfolio. Look at gold, Bitcoin, and certain commodities to hedge the chaos. If you're staying awake at night, take a pause. Ride out the near term with cash and short-term bonds or money markets, and do not over-leverage yourself with debt. Let's get real for a minute. You've probably felt that pit in your stomach when the market tanks. Your 401k drops 10%. The news is all doom and gloom, and suddenly you're thinking, should I sell everything? That's your emotions talking, and trust me, they're not your friend in a crisis. Here's the thing. Fear and greed are the two biggest traps for investors. Fear makes makes you sell low, hold on to assets too long, or frees you from doing anything at all. Most people do not find out until it's too late and they are reacting versus being proactive. For example, a seasoned investor saw the volatility coming with the tariffs and underlying financial reporting, along with the technical indicators starting to scream something is coming soon. Like during that 5% drop on April 3rd, the trade in play for that was a short or an options contract on the indexes moving down. Now the indexes are below their 200-day moving average, and it's hard for them to get back over that threshold, signaling a more bearish future for equities. Locking in losses you might have avoided. Greed. That's what pulls you into those bull market traps we talked about. I've been there, watching a stock soar and thinking, I can't miss out, only to buy right before the dip. Now is not the time to let your emotions react. Looking at the geopolitical atmosphere, coupled with the trend in technicals, are all pointing towards a volatile period of time. Volatility can be your friend or your worst nightmare, depending on how you interpret what the information is telling you. Traders like myself like this environment because it gives us opportunity for big market movements that we can make money. If that is your plan, tighten up your trading time frame and candles so you can see the moves quicker on the technicals. Look at this. When the VIX spiked to 50 this month, the S&P 500 was still above its 200-day average. That's a fact, telling us this might be a correction, not a crash. But now the indexes are below, and only time will tell us if they can get back over and stay over this important threshold. Knowing that can keep you grounded. Check your portfolio's allocation and keep your plan on stop losses to prevent large downside losses. Facts like these cut through the panic. For us over 35 with kids, mortgages, or aging parents to think about, knee-jerk moves can cost years of progress. So take a breath, look at the data, and don't let your emotions run the show. How are you handling this market madness? Drop a comment below, and if you found this helpful, hit that like button and subscribe for more. See you on the next one.